Hello and welcome to this market special from Business Today. I'm Udayan Mukherjee. With me is Abha Bakhaya, and our guest today is Anil Sarin, Chief Investment Officer, Equities at Centrum Wealth. Centrum has been running some of the most successful PMS schemes over the last 3-4 years in India. Anil, it's very good to have you on the show. Let me compliment you on your performance for the PMS schemes, which over a long period of time, medium-term time frame, has actually been one of the better performers, best performers. So perhaps you could start by giving us a flavor of what kind of holdings, whether top sectors or top stocks, which have led to this outperformance compared to some of the other schemes at Centrum.
Thank you for your appreciation, Udayan. It means a lot to me coming from you. This performance obviously is over a longer period of time. So there are 10 years, 5 years, 3 years, and there has been, as you would understand, different points in time, different investments. But by and large, I mean, what we try to do is to have a combination of 2-3 different styles, which has worked to sort of retain relevance during different periods of the market. So, as you very well know, when the economy isn't doing well, that time quality stocks do well. And when the economy is doing well, then people want to experiment. So small caps and mid caps tend to do quite well during those periods of time. And there are other periods when value stocks do very well. So what we try to do is we've got this QVG framework, quality, value and growth. And we have certain proportions, which of course change a little bit, but by and large you would say they are equal kind of proportions, where we try to ensure that we remain relevant during the different phases of the market and different phases of the economy.
So which way is the portfolio tilted or skewed at this point in time, given your outlook on the economy and the markets? If you were to say, look at the top 10 holdings of your PMS schemes, what is the tilt towards? Is it towards quality? Is it towards value? Is it towards growth from the framework that you just outlined?
So it is, for sure, it is mostly towards growth. Then there is quality, and then there is value in decreasing kind of orders of percentage. So growth, basically it is about bottom up stock picking. But if you were to look at it thematically, if you were to look at it in terms of what is working, so yeah, one would say, as a theme, lending is back. I mean, we have had a period of time when notably the PSU banks, but many private sector banks were also undergoing some asset quality issues. Then in the recent times, there was this COVID induced, Supreme Court moratorium, where you could not really go and recover your bad loans from people who aren't paying you back. So there were some headwinds, and then there was also this issue of foreigners continuing to sell for, I don't know, some 7-8 months at a time, and they were selling what they owned, which was banks and IT stocks. But now those kind of issues are behind us. So you see bank lending doing quite well. So within the BFSI space, we like lenders more than we like asset managers and more than we like insurance companies, etc. So lending is one theme. The other theme is the return of commercial vehicles. I mean, commercial vehicles typically they have a 4 to 5 year cycle. And we think that the next cycle, the up cycle, has just recently begun. So that could be another theme that we are trying to play through, directly or indirectly, through the stocks that benefit from commercial vehicles, namely trucks, starting to do well. Another theme that we are focusing upon now is logistics. So we have a bunch of companies that are very capable in terms of technology, in terms of on the ground, feet on the street, distribution reach. They have good clientele, and they have relationships, with different providers in terms of road transport, air transport, sea transport. So multi transport operator kind of a framework, but they aren't fully utilized at this point in time. So and they have a characteristic that, barring one, which is a recently listed logistics name, all of them are 7,000, 8,000 crores market cap and below. So ownership is very, very poor amongst the larger institutions. So, like I said, not fully utilized, but fully capable of meeting the needs of the corporate sector for reliable, transportation with full information flow and traceability and trackability, etc. Fully capable on the IT side, etc., but not yet utilized. So there is tremendous operating leverage in store as we go forward, as more and more corporates choose to go the organized sector with the organized sector players, as opposed to using discrete trucking, discrete shipping, discrete air logistics. So that's another area where we feel pretty confident and hopeful. Another theme, of course, is healthcare. Now you can play it through diagnostic companies, or you can play it through hospital companies. So a long way to go. It is, both these are benefiting from the growth of health insurance, which, as you know, is growing very, very fast. So it is an ancillary kind of a play on the growth of insurance, which is all these hospital companies. So these are some of the themes that we are going after. And then there are a lot of bottom-up bespoke names,
Right.
Where you really can't slot them into a theme, but they are also there.
No, this is interesting, Anil, because the sectors that you've just spoken about, whether it's on the lending front or commercial vehicles or healthcare, they seem to be more or less plays on the domestic economy. Should I infer, therefore, that you are not as optimistic on the export plays, like maybe pharmaceuticals or information technology, or even chemicals, specialty chemicals? You don't find that much value in those spaces or growth?
No, so we are there in the specialty chemicals space, but those would be, if I were to reflect upon it, those would be more domestically focused, with some export being there. Pharmaceuticals, no, we are not so constructive at this point in time. In information technology also, we like the product companies in preference over the services companies, mainly because once you have built up your distribution and brand, then the incremental benefit from owning IP is more than what you would get from being a well distributed, well accepted services company. Obviously, the main reason behind that is that there is much lesser operating leverage, and these days transport costs have gone up, and also the labor costs have sort of gone up. Attrition is very high. So we like IT, but we are playing it through product companies for the reasons I outlined. But yeah, by and large, what you said is right. If you were to sort of split it up, it would be 3/4 of our portfolio, or more than 3/4 of our portfolio, would be domestically focused.
I want to understand, Anil, where the confidence is coming from in the retail story. I mean, we know, of course, that the retail participation has been immense and that some of these sectors are expected to benefit from that. But given the overarching theme of everything getting costlier, and that perhaps putting a squeeze on spending, for example, is there any risk to this theory, or is the domestic story so robust?
So, yes and no. I mean, as you know, there are many Indias. So there are people who are less affected by inflation or by these tighter economic conditions. Or there are youngsters who are fairly amenable to advertising, and they are in sync with latest trends. So let's say if you go with QSR companies, they, in the most recent quarter also, they have shown, QSR, I'm talking about the McDonald's and the Burger Kings of the world, or the Jubilants of the world, they are showing rising profitability at the gross margin level. So yeah, that is so selectively you can find pockets of affluence, of rising profitability, and a long runway of growth, and where the valuations are not yet at extreme levels.
Right. You know, you spoke about the commercial vehicle cycle earlier. In the past, not always, I mean, it has coincided those cycles with some kind of a capex offtake in the country. I mean, many of the times they have been synchronous. I mean, you've seen CVs do well, and you've seen some of the capex plays like the capital goods, etc. They also not doing too badly. Are you constructive on that part of the market, or are you suspicious that this capex cycle may not unfold in the way people are expecting?
No, I think you have hit upon something very interesting, and I should have brought it up. We are actually very constructive on capital goods, and we are constructive on even real estate. That also seems to sort of coincide, although real estate cycles tend to be much longer than the commercial vehicle cycle. But these two things I would like to add: commercial vehicles, real estate, as well as capital goods. Now, capital goods have a characteristic that, you know, on a headline basis, the valuations appear to be forbidding. So you need to think through. I mean, are you fully geared in terms of, I mean, what potential is there for your revenue to rise? Is it expensive in relation to that future revenue potential, or is it appearing to be optically expensive because right now it's only order books that are rising and revenues have yet to show the full extent of the rise? So we are in the latter camp, that it is, if you see the book to bill ratios across the board among some of the leading capital good names as well as some of the lesser known capital good names, this is a persistent trend that we have noticed, that the order books are rising consistently and very nicely. So that is one aspect. So to answer your question, we are constructive on capital goods, and I just wanted to introduce one more feature of our portfolio, which is real estate, and we are very constructive even on that.
How are you playing real estate though, Anil? I mean, are you more focused on the real estate companies like the Godrej Properties, etc., or the Prestige Estates of the world, or are you more inclined to play it through building materials?
No. Clearly, the home manufacturers. I mean, it's a very interesting situation, Udayan. I mean, where the demand is showing early signs of revival after many years of poor demand, but the suppliers have consolidated like anything. And you know as well as I do that in any industry, I mean, one of the requirements for good performance in the stock market is that there should be pricing power. And how does pricing power come? There should be more demand relative to the supply available. So thanks to this RERA and dematerialization and GST and all the bad experiences of the past, now there are only a handful of trustworthy home manufacturing brands that are left. So that's an interesting kind of a market setup. And today, if you look at the whole sector, you would see between 17 to 18, maybe 19% revenue growth potential, which is both volume as well as value. And you will see upwards of 20% return on capital at a project level. And you are paying roughly 18 times EV/EBITDA as a multiple. Now, 18 times EV/EBITDA multiple on a headline basis would appear to be expensive. But as you know, in India, any industry, any company that shows promise for longer term growth, Indian markets tend to reward those companies and industries with very healthy, with very high valuation ratios. So in relation to what, let us say, specialty chemical or retail or QSR, etc., all the promising high growth sectors, in relation to the valuations of those sectors, 18 times EV/EBITDA would be 18 times, I'm using a rough number, but that would appear to be cheap. So it's a very interesting setup. Now you combine that with players who are commercial real estate oriented or also retail real estate oriented. So you get an interesting combination. So we are playing it as a basket. We have a fairly large exposure to such home manufacturers and commercial stroke retail mall players, and we are doing it for the reason that we want to diversify. We are also doing it for the reason that many of these companies are dealing with investors only in recent times, so we don't really know how they are going to behave in terms of incremental capital allocation. We don't really know on a medium term basis how they are going to be thinking about dividending versus reinvestment decisions. But by and large, as I mentioned, the setup is very interesting, where the demand is higher and expected to be higher, and the supply is constrained.
Well, you've spoken a lot about India and its emergence on the larger emerging market stage as really the market to look at seriously. Just share with us the thinking behind that, the rationale, and how you see India gaining an edge over some of the other markets in the region.
So I'm sure other people would have told you on your forum and otherwise that for the last I've been seeing it nearly for now 3 decades. India was treated as part of the emerging markets basket. So you would say, India will get its share, but it will be out of what we decide we want to invest towards emerging markets as an asset class. It's only in very recent times that we have started hearing institutional investors abroad talking of India as somewhat distinct from the emerging markets basket. So that's a very positive trend. It has taken a very long time and a lot of explanation by salespeople from India trying to explain to them that look, India is not fitting the classic profile. We are not a commodities exporter of any consequence. We have a services export profile which I don't think any of the other emerging markets represent. So now I think we will see India emerging as more and more people will decide that they want to invest in India as somewhat distinct from what they would otherwise invest as India being part of emerging markets. That is one aspect. And the second is the relative decline, and I'm not making a value judgment, but on a investor attractiveness basis, the relative decline of China, where they have some internal issues as well as some geopolitical development that are there, which is making investing in China less attractive now than it used to be in the past. And as you know, China typically attracts 10x the kind of investment that India does, whether it is FDI or it is FII. And in fact, in debt, they are 100x that of the debt flows that happen in India. Now, if you just imagine a situation where China is less attractive, but there is this amount of capital that needs to find a home somewhere. So India represents a good alternative. And all you have to do is take 10% of the flows that were till yesterday going into China and direct them towards India. Now, from India's standpoint, it becomes a 100% increase. So that, I think, is the math behind the India attractiveness that some of the foreigners are now keeping India as distinct from emerging markets. That would be one of the driving motivations.
Anil, good to hear your thoughts today, and thank you very much for joining in. Good luck with your PMS schemes, and keep up the great performance. Thank you for your time today.
Thank you. Thank you, Udayan. Thank you very much.
वीडियो पसंद आया तो हमें लाइक, कमेंट, शेयर और सब्सक्राइब जरूर करें।